Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets of the corporate world without all the boring jargon. Today we're diving into some regulatory news and financial updates from Sempra Energy and its subsidiaries, San Diego Gas and Electric and Southern California Gas Company. Get ready. Because sometimes the most interesting stories are hidden in the smallest of details. And hey, if you like getting these kinds of breakdowns directly from company filings, make sure you are subscribed. We also have a Discord community linked in the description below if you want to chat more about these deep dives. Alright, so what we have here is a Form 8K filing, which is basically a report of major events that shareholders need to know about. In this case, the earliest event reported is the 18th of December 2025. This filing covers updates on some important regulatory decisions that affect Sempra's California utility companies. First up, let's talk about Sempra itself. They are a big energy infrastructure company and the main player here. The filing lists their basic information, like their incorporation state, which is California, and their employer identification number. Then we have San Diego Gas and Electric Company, or SDG&E for short. They provide electricity and gas to San Diego County. Their address is listed here, but honestly, for us, it is the business dealings that matter, not their mailing address. And finally, Southern California Gas Company, also CalGas. They are the largest natural gas distribution company in the United States, serving most of the Southern California population. Again, the details about their location are less important than the financial and regulatory news. Here we see the securities that Sempra has registered. Most notably, their common stock trades on the New York Stock Exchange under the ticker FREE. They also have some subordinated notes, which are basically a type of debt they've issued. Now, let's get to the heart of the matter. The California Public Utilities Commission, or CPUC, is a really important regulator for these companies. They make decisions that have a huge impact on how much money these companies can make and how they operate. The CPU often issues proposed decisions, or PDs, before making a final decision. These proposed decisions can be changed, or even completely rejected. So, on the 18th of December 2025, the CPU made a final decision on the cost of capital proceeding for SDG&E and CalGas. This is good news because it's an improvement on an earlier proposed decision. They are authorizing a higher return on equity by 5 basis points. Now, a basis point is 1/100%, so this is a small but positive bump that allows the companies to earn a little more. All other aspects of the original decision that were reported back in November 2025 remain the same. But here is where things get a bit more complicated. On the same day, the 18th of December, the CPQ did not vote on a proposed decision regarding SDG's Track 2 request in their 2024 general rate case. This is a bit of a stall, and SDG&E is actively trying to get a better outcome from this proposed decision. Here is the kicker. SDG&E estimates this proposed decision, if it becomes final without changes they like, will result in a massive $471 million after tax charge to the earnings of both Sempra and SDG&E. Now, this charge covers a lot of ground. Some of it, $34 million, relates to the first 3 quarters of 2025. But the bulk of it, $437 million, is related to older periods from 2019 all the way through 2024. This is a significant hit to their reported earnings, and they acknowledge these estimates could change quite a bit depending on what the final decision looks like next year. Now, how does this affect Sempra's financial outlook because of this estimated charge? Sempra is now guiding to the high end of their previously announced full year 2025 adjusted diluted earnings per common share, or EPS. Guidance range, this range was between $4.3 and $4.7. So they are aiming for the $4.7 mark. However, when we look at their EPS guidance calculated using standard accounting rules, what is called GAAP, they are updating that range to between $2.38 and $2.78. This is a big difference from their adjusted guidance. This GAAP number includes the estimated charge from that proposed decision, showing a much lower profit. Looking ahead, Sempra is affirming its full year 2026 adjusted EPS guidance range, which is set between $4.8 and $5.3. This forecast already takes into account the impact of that cost of capital decision and the potential hit from the Track 2 proposed decision. So they seem to be looking forward past these immediate accounting adjustments. The report also mentions Exhibit 99.1, which contains the detailed reconciliations between their adjusted EPs and their GAAPP's guidance for both 2025 and 2026. This is where you'd go to see the exact math behind these numbers. Now, let's talk about risks. The report details a whole list of risks that Sempra and its subsidiaries are facing. This is a really important part of any filing because it tells you what could go wrong. They mention wildfire risks in California, which can lead to huge liabilities and insurance challenges. A huge chunk of their risks comes from regulatory bodies like the CPQ we just talked about, but also many others in the US and Mexico. These regulators can deny cost recovery, meaning they might not get paid for certain expenses, revoke permits, or issue unfavorable regulations. They also face risks from international trade policies, litigation, and cybersecurity threats. Then there is the constant challenge of capital. They need to be able to borrow money and raise capital at reasonable costs to fund their operations and growth. If their credit ratings get downgraded, or if the financial markets become unstable, or if interest rates and inflation go wild, it becomes much harder and more expensive for them to get the money they need. This is a pretty standard risk for any large company, but it's especially critical for utility companies that have massive infrastructure needs. Climate change policies are also a significant risk factor. California in particular is pushing hard to reduce reliance on natural gas. This creates uncertainty for companies like SoCalGas. Trees a risk of what they call stranded assets, which means infrastructure they've invested in could become obsolete before its useful life is over, and they might not be able to recover those costs. And of course, there are the unpredictable events. Weather, natural disasters, accidents, equipment failures, you name it. These can disrupt operations, damage facilities, lead to environmental issues, and result in significant liabilities. They also mention the difficulty of obtaining affordable insurance for some of these risks, which just adds another layer of concern. Finally, we have the signatures. This is where the authorized representatives of each company, Sempra, South Dakota GC, and SoCalGas, sign off on the report, attesting to its accuracy and completeness. Looking at the dates here, the report is signed on the 19th of December, 2025, just one day after the events reported. So, what is the story here? Sempra's California utilities, South Dakota GB, and SoCalGas are navigating a complex regulatory environment. While they received some good news with a slight increase in their authorized return on equity for their cost of capital, they are facing a potentially significant financial hit from a separate proposed decision in SDG and E's general rate case. This hit is being reported as a large after-tax charge. Now, for our take, on the strength side, Sempra is a major player in a critical industry, providing essential services. The fact that they are guiding to the high end of their adjusted earnings guidance for 2025, despite the estimated charge, shows some resilience. They also affirmed their 2026 guidance, suggesting they believe they can manage these regulatory impacts over the longer term. However, there are clear weaknesses and risks. The large estimated charge for prior years from the Track 2 proposed decision raises questions about their earlier forecasting and operational management. The extensive list of risk factors, particularly those related to regulatory actions and climate policies, highlight the inherent volatility in their business. The discrepancy between their adjusted EP's guidance and their GAAP EP's guidance is also something to watch. While adjusted earnings remove certain items to show the underlying business performance, the GAAP app numbers are what truly show the company's accounting profit, and in this case, the GAAP guidance is substantially lower. A notable opportunity is their continued focus on infrastructure and future growth as suggested by the 2026 guidance. But a significant risk is their heavy reliance on regulatory approvals and the potential for unfavorable decisions that can impact earnings significantly and retroactively. In conclusion, Sempra is a company in a tough but necessary business. They are managing significant regulatory headwinds, and it appears they are trying to put a positive spin on things with their adjusted earnings guidance. Investors need to pay close attention to the final outcomes of these regulatory proceedings, especially the SDG and E-Track 2 request, as it could have a material impact on the company's financial health. It is a classic case of a regulated utility trying to balance investor expectations with the realities of strict oversight. Alright, that is our breakdown of Sempra's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think they can manage these regulatory challenges? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord link in the description to join the conversation. Thanks for watching, and we'll see you next time.